It doesn't require the like kind, and it doesn't require that the whole entity move, because it's just an installment sale.
One exchange into a syndication, which is what we do. In fact, it's the only way to do it really is to set up a tick alongside of the syndication. So in this situation, because you don't have to have a like kind exchange, would you then put it in the DST, and then are you able to purchase shares in a syndication?
Great question. Yes. So one of the biggest challenges that operators and syndicators face is they don't accept 1031 money because it's too complicated typically, right? Unless it's a really, really big deal, then they'll carve out a small amount. And also, when they sell the entity, they don't do a 1031 exchange because it's too hard to get the whole entity to move. And so, in the past, people did what's called a drop and swap, where they drop their interest into another entity and go off on their own way. But the franchise tax board has become even more and more strict on that, and they're calling exchange fails. So, literally, 95% of the operators and syndicators I work with do not accept 1031 money and aren't doing 1031s on the way out. And they're faced with capital gains tax, and they're paying every single day. So what's really unique about the Deferred Sales Trust, we call it the seamless partnership separation, and that it works for carried interest and it works for individuals where they can take their portion and move it into a Deferred Sales Trust. And the other, let's say there's 10 investors, the other 9 can pay their tax. Or 5 of them can do their own Deferred Sales Trust, and the other 5 could pay their tax. It doesn't require the like kind, and it doesn't require that the whole entity move, because it's just an installment sale, which might be a good time to walk through for your listeners just kind of how this works. So Kyle, you're selling, let's say, a $10 million multifamily apartment complex, right? Syndication deal. And of that, you have $2 million of your own interest in it. The other $8 million is other investors. For you, you could have your $2 million go to your own individual Deferred Sales Trust. And essentially what you're doing is you're taking a zero down payment from this new entity that's created, a new business trust. We'll call it Kyle's Deferred Sales Trust, okay? Where's that money coming from? Well, it's coming from that buyer that you already had lined up. That $10 million buyer, of that $2 million, he's actually buying it from the trust. And this is really the secret sauce of all of this, which is actually really simple. Kyle just did 100% seller carryback of the $2 million that was owed to him, and that buyer actually bought his position, but through the trust, and now he takes title and he's gone with the whole entire property, and you just did a carryback, and this is why it works. And so the smoke clears, the funds are sitting in the trust, and again, the other investors could have paid their tax if they wanted to, or they might say, hey Kyle, I kind of like what you're doing there. I have about $500,000 in tax and $1.5 million in my interest. Let's do my own Deferred Sales Trust, and it's separate from Kyle's. And then the next deal you guys do, up to 80% of that total proceeds of that trust can be used to reinvest into a new syndication deal via a brand new LLC. So it doesn't change the nature of your entire structure itself. It's just another LLC that's investing. And then we do what's called rinse, wash, repeat, and that all of the proceeds from that next deal just roll back into the trust. And now we have a new, bigger 80% to work with. And the other 20% is sitting in stocks, bonds, mutual funds, and earning interest.